Okay, so we will get started then, and we are here today to celebrate the publication of Dr. Daniela Dalvia's book, Analysing Special Purpose Acquisition Companies, or SPACs. And as far as I'm aware, this is the first book to look at SPACs from a theoretical and practical perspective and comparative perspective. And although they are a hugely important aspect of international finance, there is not a lot known about SPACs, how they operate and how they are regulated. And that is why it is great to see a book like Daniela's. Indeed, in reviews, the book has been described as a must read. And what I know about SPACs, I've learned from Daniela when we were talking about them at IELTS. So I am delighted to welcome Daniela here today to talk about his book and to take any questions that you might have. If you do have any questions, please feel free to put them in the chat, and we will come to them after our speakers. So Daniela then is an Associate Research Fellow here at IELTS and a Teaching Fellow at Queen Mary University of London, and he also teaches at Birkbeck College. Our two commentators are Paul Davies QC, a professor at University of Oxford, and Catherine Arias Barrera, a professor of commercial law at Externado University in Colombia. So I will pass over to Daniela now to introduce his book. Congratulations, Daniela.
Thanks. Thank you very much, Colin. It is a pleasure for me to be here today, and also, accompanied by so distinguished professor like Professor Paul Davies and Karen Barrera Arias. Just few points. I think that Paul then can introduce in a broad way the topic. I would like to say that at the moment we are experiencing a difficult moment in special purpose acquisition companies and offerings. And this especially if we look at the level of redemptions that are those rights of shareholders to redeem their shares and their money if they are not happy on the business combination. The rate has been quite high, and this, as a matter of fact, is undeniable. But it's also true that this kind of redemptions are the result of the rising of inflation. Because at the moment around the world, in the US, UK, and Europe, and so on, inflation is something that is concerning. And of course, investors, they need liquidity. So for sure, one factor of those redemptions is connected to inflation. But another factor for sure is connected on the quality of the business combination and the quality of management of the sponsors that are there in the SPAC, and that actually they need to carry out this kind of acquisition process. So the industry in SPAC is evolving. This is the first remark that I would like to make. The book is a book that actually started as a book that I started to write when I was much younger. I was 22, 23 years old, and now I am 35. At that time, I still remember that if I went just to search for a book, there was no book on SPACs in English. There was only a book in Italian, and then some books in German, because let's say, strange way, I don't know why, but the Italian scholars and the German scholars, they like SPAC. So this is something that is still continuing in some way. And from that moment, I was working in Italy as a junior associate, as a lawyer in a commercial department of financial markets of Bonelli Rede, that is a top tier firm in Italy. And at that time, we discussed, of course, the possibility of SPACs in Italy, if it was possible to have a SPAC under Italian corporate law. And this is something that still today is a question that is opened, because, of course, as I mentioned at the start, there were redemption rights is something very important in the SPAC, because the SPAC basically is a shell vehicle that is going on the market, the sponsor is going to select one target company to acquire, and then if the deal is not promising, or if the investors, they perceive that the market circumstances around are changing, like with inflation or other processes around the market, the investor is going to redeem the money. This redemption right in common law countries traditionally is quite simple to do or to implement, and especially in the US, because they also had, let's say, a sophisticated way to actually implement a redemption right, as opposed to all the rest of the world. Because basically is the figure of the model of the SPAC 3.0, where there is a shareholder that can redeem the shares, and it has still the right to keep the warrant. The warrant, because at the IPO phase, the SPAC is issuing units that are composed of warrants and shares. And so this possibility to keep the warrant and to have still a bet on the future acquisition is something that has constituted a drive of the SPAC in some way, especially in those years in the US. In Europe, this kind of redemption right is subject to different corporate law provisions in different legal systems. So it is extremely variegated. And this is something also why in Europe we don't see the same level of SPACs as in the US, for example. And when I started to research SPACs, basically, if I went also on Google, there were maybe 100 results. And now, if you go on Google, there are, you just digit SPAC, there are 150 million results. So in some way, the market, or in general, the topic has evolved significantly. In my book also, I speak about believers and disbelievers in some way of SPACs. And why? Because the SPAC phenomenon has been a sort of, let's say, a fancy trend at some point. And we have seen this especially in the US with stars from movies, or even the President Trump, former President Trump, is involved in a SPAC deal at the moment, and has, of course, had a lot of critiques around this kind of deal. And also other former presidents like Clinton and so on, or other advisors of the governments, they were all involved in SPACs between 2020 and 2021. So for sure, once you see that there are businessmen, but also movie stars, also former presidents, you start to see that this is like a trend. And so the big question is, it is a trend or it is something that is here to stay? Actually, it is something that for sure in the US is here to stay, but it is something that is going to be maybe in 10 years time, 5 years time, look a little bit different. And this is why, for sure, we need to say that in the US, there is a legal framework. And this is something that I leave then also Paul and Katriane to speak more about it. So there is a legal framework where in some way the SPAC is regulated. So our investment vehicles, yes, but they are heavily already regulated. And the Congress actually in the US in 2022, we are expecting new regulation. So new regulation is coming to protect investors, and especially to protect retail investors in this case. And also the possibility of SPACs to use forward-looking statements during the process of the acquisition process. So in the US, is quite dynamic, the regulatory environment. In Europe, the main stance is that we look to a regulation by objectives. So basically, we don't regulate SPACs by business, saying they are investment vehicles, investment companies, sorry. But we leave this a little bit free for member states to regulate SPACs. And in fact, we started to see that Belgium has adopted some rules. Italy has other rules in place in Milan, and the same especially in the UK. UK is the only state in Europe that has a specific SPAC reform. And so this is something, of course, due also to the political relationship between US and the UK. Let's say from a comparative point of view, it's like a copy and paste of the rules. with some differences, because there are always differences. So those are legal transplants, so we can say in the acception of Alan Watson. But every time that you transplant a legal concept from a foreign legal system into your own legal system, you need to adapt this concept. And in fact, UK has adapted this concept with specific rules that look a little bit different from the US. And the same is happening also in Asia, especially in Asia, in Hong Kong, or for example, in Singapore. In India, they are studying the possibility to implement a new reform. South Korea, Malaysia has already implemented a new reform on SPACs, and they already had a reform on SPACs in 2009. So basically, at least from a regulatory point of view, we see that there is a development in the world. We see that in some way, the SPAC is something that a legal system must have in some way. Must have because it depends. It became something that can be even political. So the fact that, for example, now if we see and we look at US, where the majority of SPAC activities, happened, there we had like more than 100 billion in proceeds raised in 2021. And this is something that for sure is remarkable. But on the other hand, what does it mean? It means that a SPAC is in the US, in New York Stock Exchange, NASDAQ, and then is going to acquire another company that many times, or sometimes at least, is not American. Many times can be like the case of Grab, so from Singapore, and now is listed in New York, or the case of Italian companies, like the Zegna Group, that is a fashion company, very important, and now it is listed in New York. The same with the case of Arrival in the UK, Kazoo in the UK. So basically, a little bit from a political point of view, the SPAC is an instrument also to attract more companies and more money inside your own legal system. So it's also true that we can say that these other legal systems, so in Asia, in Europe, that they started heavily to adopt in some way new regulations on SPACs, it is also a form of protection in some way from the let's say, I don't want to say the attack of the US, but in some ways like the aggressive, form of investment that there is in the US. And this is also something that in the book, I write once I speak about the different conceptions of risk and uncertainty. So the fact that, for example, an investor in the US is more aggressive, even traditionally, even in its mind, because risk-taking activities for him is something good. In Europe, we tend to be risk-averse. And in fact, for example, I think in the UK, the SPAC reform looks very risk-averse in some way, or uncertainty aversion paradigm in some way, to say that we tend to protect and to keep an eye, especially in the European Union, if we think at all the forms of protection that retail investors and investors as a consumer, they have on the financial markets regulations. And this is something that, of course, is important. Probably we were pioneering this more than the US in some way. But on the other hand, it's also true that the US, they have a system where the litigation, securities litigation is always on the rise. So, for example, even today, if I need to, set up a SPAC, sometimes, at least in this moment in the US, is quite risky, because the Securities and Exchange Commission and the investigatory powers that they have are always more penetrating in relation to the SPAC in the US. While, for example, the securities litigation as a matter in the UK and as a matter traditionally in Europe is less concerning in some way. So those are also all kind of different approaches that the book is taking, and is showing, as you were saying, Colin, probably for the first time also, this comparative law point of view on SPACs and on financial regulation. How also, in some way, although the legal systems, they can be different, they can have different legal frameworks, there is always what I define a legal constant. So a legal constant, and this is something that I write also in my another book that actually by the end of this month is being published, and is a book on international insolvency and finance law, legal constants in terms of crisis is called. And these legal constants are a sort of development in some way of that theory of Alan Watson of the legal transplant. So that once we take a concept that is a legal concept or a legal model, such as the SPAC regulation in the US, this legal concept, although we can even copy and paste the same structure, really the same structure, will be destined to change in meanings. So the meanings of the law, they are always changing constantly. And this is something that in the SPAC is quite evident, but it's evident also in other areas of the law, like also in insolvency law at the moment. And so if we think about restructuring procedures, there are many ways to implement restructuring procedures, but we go always on the same thinking on what does it mean, a business rescue. So those are the legal constants that are around today, and that today, what I claim in the book in some way is the fact that the authority of the state is losing power. So with a world that is more digitalized, with a world where there are alternative forms of investments like the SPAC, direct listings, we start to face a challenge to common wisdom. The common wisdom that wants, for example, traditional IPOs to be the only way to raise capital in a company, or the common wisdom that wants that there are only public money and private monies like bitcoins, and so cryptocurrencies can be another kind of erosion to monetary sovereignty. So this book is also speaking about that. It's speaking about this new instance of uncodified codification of the law. So the fact that many times we tend in this kind of era, especially post-COVID, to have a sort of approach to the law that starts from a non-legal stance or instance, and then we go to develop some form of regulations. So this is just, I think, a very brief introduction and touching really, on points that can summarize at least the soul of the book. And I leave the floor to Paul. Thank you very much.
Thank you very much, Daniela. It's a great pleasure to be here, both because the subject of SPACs is obviously one of enormous current interest, and also because this book, whose launch we're celebrating, is an absolutely major contribution to our understanding of the schemes of regulation of SPACs. And now, I have a long-standing interest in the regulation of financial markets, capital markets. I don't claim to be a particular expert on SPAC. So what I thought I would do is present a view of how one might frame the policy issues for regulators, which it seems to me that SPACs raise. And in order to do that, I'm going to try and share my screen. Is that successful? Everybody see the screen? Great. Okay. Thank you. So my claim is that SPACs are interesting at a general level because they're a fascinating context in which to discuss and study the potential conflict between what I regard as the two core goals or core internal goals of financial regulation. Now, I'm not sure internal is a terribly good word, but what I'm intending to do is exclude from the discussion the goal of financial regulation, obviously a very important goal, which consists of providing stability to the economy as a whole. So if we exclude the stability role of financial regulation, what I claim is that financial regulation is concerned with two things, namely reducing the transaction costs for companies wishing to raise finance on the public markets on the one hand, and protecting investors from manipulation on the other. Now, it seems to me that both these goals are obviously desirable. Reducing the transaction costs of companies seeking to raise money on public markets is obviously good for the companies seeking finance. I think it's good for the companies that are already on the market, because new listings tend to improve the liquidity and depth of the capital markets. And it's obviously good, I think, for society as a whole, so long as we're relying on the private sector to provide a substantial amount of the goods and services that we use in society. So better, cheaper access to funding on public markets means cheaper provision of those goods and services. On the other hand, the second goal of financial regulation is to protect investors from manipulation. Investors understand they're running risks, but if they think that financial markets are systematically rigged against them, then they will either not invest less, or invest on less favorable terms than they might otherwise do. So this is a very simple point. What I'm saying really is that there's no point in encouraging the demand side for public listings, companies seeking finance, if there isn't the supply side available to meet the demand. So I think it's intuitive to see that at some points there's going to be a trade-off between these two goals. And the problem, therefore, is to identify the optimal balance between these two goals. So the question, I think, in relation to SPACs, and the reason why I find SPACs interesting, is how does this general approach play out in relation to SPACs? And now I'm going to take as the text for my sermon a quotation from page 9 of Daniel's book, which is that with a SPAC, you have, instead of an operating company seeking investors, you have investors seeking an operating company. So let's see how that plays out in relation to, first of all, the operating company and then the SPAC investors. So let's take a core example of a SPAC investment. You have a private company, a company which is currently not listed on the public markets, which seeks further equity finance for the development of its business. Now, it could obviously seek that finance through offering its shares to the public in an IPO, initial public offering, or it could go through a placing and seek investment from institutional investors and wealthy individuals, and in either case couple those steps with an introduction to shares to listing on a public market. The SPAC provides a third way, so to speak, of raising finance. A SPAC is, as Daniel said, an already existing listed company, which is a cash shell. So the money that the operating company wants is already there in the SPAC company, and the transfer of the money from the SPAC company to the operating company takes place via a merger of the two companies. The cash goes from the SPAC company to the operating company in exchange for the issuance of shares in the operating company to the shareholders in the SPAC company and also to the sponsor, but I'll come back to that later on. The surviving company from the merger is listed and the SPAC essentially disappears. Now, I think it's pretty easy to see why, from the point of view of the operating company, this might be an attractive way of raising finance as compared with an IPO or a placing. It's because the risk of the fundraising failing is substantially reduced because the cash is already there in the SPAC. The operating companies, the risk of the fundraising not reaching a successful conclusion is, as I say, very much reduced. So the operating company is able to avoid the risk that it's thrown away the cost that might be it will incur if it engages in an unsuccessful IPO or placing. And it also is able to avoid the costs of the mitigating mechanisms which exist to reduce the chances that the IPO or the placing will fail, such as underwriting costs, roadshows, and the costs of conveying information to the market. So I think this is a clear benefit, a transaction cost reduction for operating companies. It isn't, of course, a guarantee that the merger between the SPAC and the operating company will go ahead. I mean, as in any merger negotiation, the transaction may break down. For example, if there's disagreement between the SPAC management and the operating company management over the valuation of the operating company. Nevertheless, it seems to me clear that this is a potentially cheaper way for an operating company to raise finance. What's the situation from the point of view of the SPAC investor? Well, it seems to me from the point of view of the SPAC investor, the big problem is that at the point in which the investor puts the money into the SPAC, it's a mere cash shell. And the investor doesn't know where the company's money is ultimately going to end up. The investor is reliant on the skill and diligence of the SPAC management to find, complete a merger with an operating company, or if it fails to do so, to return the cash to the SPAC investors. This seems to me quite a good example of the need to pursue both goals, transaction reduction and shareholder protection. And the question is, can you pursue them in a way which doesn't involve, from time to time, conflict between these two goals? Well, let's look first of all at how one might engage in investor protection. You could just rely on ex post fiduciary duties, right? I mean, given the reliance of SPAC investors on the diligence and loyalty of the management of the SPAC, obviously fiduciary duties come into play. But regulators, I think, are rather skeptical about the utility of ex post standards because of the uncertainty as to the level of redress that they will afford. Regulators prefer bright line ex ante rules. And so regulators, or the practice of SPAC managers, has developed the three bright line rules which I put on the slide, designed to protect the investors in SPACs. First of all, the right, which Daniel mentioned in his introduction, of the investors in the SPAC to change their minds at the point in which it becomes clear what sort of operating company the money is going to end up in. So at the point of the merger, and this could either be a collective right to change one's mind by way of a veto of the shareholders as a whole over the merger transaction, or an individual right to withdraw one's cash at that point and to redeem the shares. The second, these 3 points are all linked, of course. The second is that the money which the investors put into the SPAC initially could be ring-fenced. So it's available only for limited purposes, namely investment in the operating company, or if there's no merger, to be returned in full to the investors. And thirdly, a time limit on the period which the SPAC management has to seek a merger partner, with the conclusion that if the merger partner is not found within the search period, then the money has to be returned to the SPAC investors. So that looks a pretty straightforward set of rules designed to protect SPAC investors. The question is, does it have any distorting effect? I mean, if it were just that, I think one could say, okay, there's no particular conflict between investor protection and reducing transaction costs. But when one takes the next step and thinks, how will the regulated respond to the regulation, then one begins to see there is a conflict of objectives. To take an obvious example, if there's a cap on the amount of time that the SPAC management have to complete a merger, then they may be incentivized as that period begins to run out to complete an unsatisfactory merger rather than to have no merger at all. And this is particularly so, I think, given the way in which SPAC sponsors and SPAC management are compensated for the effort they put in to finding a merger partner. Typically, this is done by the SPAC management or the sponsor exchanging in the merger its shares, usually called founders' shares, which is obtained in the IPO of the SPAC at a relatively nominal consideration for a substantial chunk of the equity of the merged entity. So the SPAC sponsor is essentially in the position that if no merger occurs, they don't get remunerated, they lose a substantial upside benefit, and they may even be out of pocket because they may not be able to cover the cost of running the SPAC up to the point of the merger. And this increases their incentive to do a deal at all costs towards the end of the SPAC period. Take the collective or individual withdrawal right or veto right. Well, this, of course, to some extent, restores the risk which the SPAC is there to remove from the operating company's point of view, namely the risk that the fundraising will fail. It will clearly fail if the shareholders collectively have the right to and do veto the merger, but it may also fail if there's a large-scale level of individual withdrawals of cash at the merger point, because there may be insufficient cash around to meet the level of funding which the operating company is seeking. To go to a third level, it's possible to think of responses to this risk of the SPAC failing on funding grounds, namely the introduction of pipe investors, as they're called, i.e. A third set of investors or another set of investors who come in at the moment the merger is about to take place and invest in the merged operation. Okay, so this is all a rather elaborate way of saying that it seems to me that in the context of SPACs, you have to try and find a balance between reducing the transaction costs for fundraisers and protecting investors from manipulation. And this is something of which reasonable people can reasonably differ. And it seems to me that one of the values of this book, the very great value of this book, is that it puts the reader in a position to make that judgment. May I just finish with a rather mischievous suggestion, which perhaps you may want to debate, which is that the author of this book is more on the side of the balance which involves reducing the transaction costs of fundraisers than the Financial Conduct Authority in the UK, which is more on the side of protecting investors. But we could perhaps discuss that later on. Okay, thank you very much.
Thanks very much for that, Paul. And we will pass straight over to Catherine.
Let me just get rid of it.
Okay. So firstly, thank you, Daniel, for the invite to be here and to share some thoughts about your book. I think it's as Professor Davis was saying before, the first opportunity for us that are not experts on the area of SPACs to learn not only about the evolution of this investment vehicle, but also trying to identify some regulatory challenges that might pose the growth of this market in different parts of the world. And starting by the US market, that seems to be somehow, at least historically, the leader in promoting the development of this type of the market. So what I've been thinking of doing in this part of my intervention is to share with you some of the ideas that I put together for a book review that hopefully will be published during this upcoming year. So this book, as I understand, seeks to explain the evolution of SPACs by differentiating them from its predecessors, namely the blank check companies. Daniel locates SPACs trend as a symptom of the equity era, as he calls it, where new ways to raise capital for private companies are at the heart and the core of markets growth. He recognizes, of course, that there are multiple risks that are involved and also created by this movement towards promoting SPACs. In particular, he explains and as I see it, he applauds the undeniable feature of SPACs as investment vehicles designed to pursue profit maximization. This is, in the terms of famous economist as Mariana Mazzucato, another financial activity of value extraction that the author of this book refers as money creation, or as a part of money creation. In my opinion, I would like to pose some maybe questions around how to better understand and counter-argue in detail some of the concerns that both some regulators and industry participants identify in the SPAC process. There are some detractors and critics of the SPAC movement that insist on problems regarding information asymmetry, moral hazard, and agency cost that we could find in some parts of the book briefly mentioned. In the first part, I would like to around the concepts that are proposed in the first chapter, where Daniel presents a in-depth analysis of the evolution of SPACs. He argues that probably the best way to approach this phenomena in the market is through allowing and facilitating self-regulation, or regulation that is thought and designed by those who participate in the market, who help us with market infrastructure, as for example, the stock exchanges. There's also an argument on profits as reward of risk-taking, which is at the core of SPACs. However, I missed one explanation there, or one concept that has been discussed in economic studies around how profits owe their existence to the fact that they are not reward of risk taken, but they rather are the surplus over and above the real risk that is assumed in any transaction. Then, when Daniel emphasizes step by step the process of growth of SPACs, and takes as a reference the experience of blockchain companies, there are some interest developments and arguments around how the process of voluntarily complying with the famous Rule 415 of the SEC help the SPAC movement to provide more confidence to investors that were curious about how beneficial the SPAC process and design would be. The very close and linked nature between risk and uncertainty in the context of SPACs is also, I think, an important part of the line of thought that Daniel presents in his book. After a description of risk and uncertainty that he explained before, he links the arguments towards understanding how the concepts of risk and uncertainty illustrate the SPAC's design and the functioning of SPACs. He helped us to understand that one key movement, both by self-regulation or regulatory intervention, is to make uncertainty be somehow closer to the concept of risk. So he says that uncertainty informs the SPAC's functioning. We cannot deny that part. But what is important or key in his argument, and it's imperative to adopt some mechanisms that help us to convert uncertainty into risk by providing greater access and analysis of information. However, that greater analysis and better access to information is, in Daniel's view, an approach that should be led by industry. It's a trend within the market. We don't need, as he says, a regulatory intervention. We don't need strict rules to help this trend to move forward. Then I found particularly interesting the critique that Daniel presents around the approach of the Financial Conduct Authority, and basically the argument that the Financial Conduct Authority has somehow failed to adopt some similar to the US approach, a similar approach as the US has taken in terms of decoupling mechanisms between voting rights, voting and redemption rights. As a critic, he says that the FCA seems to be mainly concerned about investor protection. And from my point of view, that's something that the FCA as a regulator cannot just ignore and overlook to provide some, let's say, more attractive market for SPACs enthusiasts. The next part of the discussion related to uncertainty refers in how, and I think this is a great theoretical discussion, and I have to say that I enjoyed especially this part of the book in chapter 6 when the author identifies markets as systems using Luhmann's system theory, and he explains that the identification of financial markets as open in financial systems is just the first step of the construction that he proposes. He says that we have to understand the functioning of financial markets, and within that context, how SPACs interact with that functioning by using and bearing in mind three main features: uncertainty, competition, and innovation. And of course, I mean, that makes sense because SPACs is a way of understanding materialization of the innovation in markets. He explains in this context as well that financial risk in itself creates profit. And we are in the stage of understanding how some market actors, especially those benefited by SPACs, I think, willingness to make profit turns uncertainty into risk opportunity, and that's basically the core argument here. Just to finish this brief thoughts around SPACs in the book in particular, I think we have to praise the book by its clear analysis of the current regulatory trends about the SPACs. I agree with Professor Davis in the sense that the arguments and how they are presented in the book make the reader reflect on how attractive SPACs as a way of alternative investment vehicle are or might be in some markets. I would like to point out that I think considerations around greater investor protection and concerns around potential problems with systemic risk are not greatly developed in probably in future research. We will see that opinion of Daniel regarding these matters. I think the arguments and the line of thought that we could identify within these 6 chapters help new markets in other countries that are trying to understand how SPACs would work, to see the process and evolution of the SPACs as well as the prospects of growth of this market. I remember last year when we had a small seminar with Daniel at our university in Colombia, that there was call from the Colombian Stock Exchange, one of them working with new products and how to work on further market development. And the query, I want to share that here. The query and the main concern in markets like the one we have here is how to ensure we have good quality promote sponsors behind SPACs. That's mainly what I identify from the discussion after the webinar we had. One of the issues that small markets like the one that we have here may have in front of open the market to the use of SPACs. So that's all for my part. I hope I could contribute to the discussion and put some questions there for Daniel to explore. Thank you.
Thanks very much, Catherine, and thanks to both Catherine and Paul for your insightful and constructive and challenging points that you raised there. And I will bring in Daniela to allow him time to respond and to reflect on some of the points made. Daniela, it does seem as if there was quite a bit of time between your idea for the book at the outset when you were 22 to the publication. So I'm delighted to hear that your second book has been finished much quicker. So good luck with that book as well. Daniela, we heard there about issues relating to regulatory challenges, the assumption of risk, the uncertainty involved. And one of our commentators flagged up issues relating to the FCA. Catherine spoke about issues relating to the FCA's failure. And Paul's point at the end was about your focus more on transaction costs, where the FCA appears to be more focused on the investor. So if I pass over to you to give you the chance to reflect on some of these points.
Absolutely. Thank you. Thank you very much also for the enlightening points of the distinguished professor before. And I think actually I would like to start with something that is quite, maybe very simple, on the fact that many times we question things with the same eyes of the past. So like, for example, if there is a new innovation in the market, so there is a financial innovation, if we read also Financial Times, Wall Street Journal, Bloomberg, but that is a little bit different because probably it's more about the press. And so journalists also sometimes they need to write a little bit to attract the attention of the readers. But it's also true that I think that we are all human beings. So as a human being, for example, if something doesn't fit in our common wisdom, we tend to, for example, criticize it, or we tend to try to qualify the new phenomenon with something of the past. And this is something that a little bit, I think has been quite maybe common even in physics. For example, if we think the theory of relativity, everyone was thinking Einstein was crazy or mad, and took a long time to discover that actually there is relativity in the universe. This is something that I think I don't want to say that the SPAC is the theory of relativity, but I have to say that the SPAC, together with maybe cryptocurrencies, so private money, with financial innovations, they are a little bit the side of relativity in financial markets. So they are a little bit this new trigger in some way that we are facing. And at some point we need maybe to start to understand that actually the real risk on SPACs is true that, of course, can be in the investor side because manipulation is not good. So the information in the market is key. And the role of every regulator is to preserve this information to be freely accessible and also to protect investors to have a right to access this information at a cost that is not so expensive. Because here the big challenge that I think, many other professors, they always questioned is the one between insiders, so the managers are the insiders of the firm, and the outsiders. So the stakeholders, the shareholders, everyone that doesn't have a control basically on the company, on the management especially. And this is something that will always be there, and it's difficult actually to solve it. It's difficult to solve it, but there are ways, as for example, Professor Davis was saying, for example, to focus our attention on the transactional cost. So for example, on the side of the transaction is where we can mitigate a little bit this uncertainty. How we can mitigate the uncertainty? At least in the US, there was a phenomenon that now also has started to decrease that was called the private investment in public equity, so the PIPE. The PIPE are qualified investors that are giving further money, so that if there are, for example, more redemptions, it's not a big problem, because if you have secured a PIPE investment, you are able to close the transaction, so to close the deal. So that could be one sort of point. I think Paul has the hands raised if you want. No, okay.
Unintended.
Okay, a legacy end. Don't worry. So now, because I was thinking about the PIPE. So now the PIPE is in the slides and is well illustrated. I mean, I can mitigate in some way that kind of transaction risk. But actually, it's in the transaction, in the risk of the transaction that we need to focus our attention, because the next trend that we are seeing, for example, in the US at the moment, is that because the PIPE deals are drying up, so there are no more money in the market to sustain this kind of business combinations of SPACs, the redemption is on the rise. And so what happened? That actually one key element that has always been there in financial markets, and actually if even we are here speaking about financial markets, is because it are not based on equity, but on debt. So debt has again arrived. And so basically at this point, because the PIPE, that actually the PIPE is more a form of equity in some way, now, in this moment, what we see on the rise is that the same JP Morgan that is going to list the SPAC is also the one that is going to extend the credit at the moment of the business combination on the value of the management. So if there are managers that are valuable, that are qualified, JP Morgan is more than happy to extend credit, because our system is based on credit, our system is based on debt. And that actually, this is maybe the new future book, maybe in some way, that the equity era, that was my first book, SPAC, that actually was maybe a rebellious tool also from a financial markets point of view. So a tool that wanted in reality to challenge this idea of debt, now has triggered again on debt once again. So once again, there is the possibility of an extension of credit, and there the problems can become, of course, debt is an amplifier. So can even happen that, of course, this time if the business combination is not successful, and so in some way the profit are not made, you don't even have enough capital to pay back that loan that was advanced at the moment of the business combination. And this is something that actually is where I see that the next crisis of SPACs is coming. Actually, from a perspective of financing, try new ways to financing those deals, but those new ways actually are connected, deeply connected with debt. And so actually, sometimes, yes, we are focusing, for example, on retail investor manipulation of the market, but then our focus maybe sometimes should be on this side, because that side of the transaction, that is the main feature of SPACs, because basically a SPAC, yes, we said that is a company, but as also Professor Davis has said, SPACs are cash shell companies. So in reality are investment vehicles, are not a real company in like operating company, are non-operating companies, in fact. And this is something that directly points our attention on the fact that once the SPAC is on the market, is looking for an acquisition to be made, it's just an investment vehicle. So it's just a company that doesn't fit inside the common definition of a company as we know it. And at that point in time, we need even to understand that actually all the main feature of the SPAC is the transaction. So it's the moment where we identify that business combination. So I think that, for example, in the US, that reform that is concerning the forward-looking statements to use at the moment of the business combination, so that what does it mean? That the private company that wants to be acquired by a SPAC can say my value is 8 billion. 8 billion that today, of course, I have actually a corporate valuation maybe of 1 billion that is effective, but I have new future stream of revenues that, according to my business plan, will be 8 billion. That is something that we need to prevent. We need to prevent a little bit the possibility that there is a trend in SPACs that, at least traditionally, they were going to target operating companies. Then they started to target positive EBITDA companies. And now they are targeting promising companies. They are targeting things like the company of Trump, for example, that is a startup and is a media company that actually, just because behind of the deal there is a person like Trump, the corporate valuation of the deal is in numbers of billions. And this is something that might be wrong. So first of all, we should look at this inclusion of forward-looking statements inside a deal. On the other hand, it's also true that if we erase completely this possibility, then the private company, they will not have this new ability to list. Why? Because usually in a traditional IPO, you need to have an history. So you need to have at least 5 years of success as a company to list. With SPACs, this is not required because the SPAC is a casual company. It's going to get the money and to raise money on the public market. And then it's going to target a private company. This private company can be a promising company, can even be a startup, basically. And so SPACs in this kind of operation that are carrying out are operating like a late stage venture capitalist in some way, where for the first time in history, a retail investor can be part of the deal, because usually this late stage venture capital rounds of financing was something that was only possible for qualified investors. Now with SPACs, also retail investor can do this. So there are some sweet sides that actually even investors themselves they like, because they can bet on the future and they can be inside this kind of dynamic of the risk-taking approach that our society is based on. On the other hand, if we allow without any limitation this kind of new approach, we can find a very nasty result in the future. So substantially, I think that the corporate valuation of this target company must be, there must be a new framework in the law. So more than focusing, basically this was the appointment, the critique to the Financial Conduct Authority, that rather than maybe focusing on retail investors, that focus may be on the transaction side. And so how we can determine this corporate valuation at the moment of the business combination in a promising company. Or for example, we can even distinguish SPACs with a very good management, very qualified managers, that maybe they are allowed to acquire promising companies. What we see today in the market is that we don't have this sort of this distinction between a good SPAC, bad SPAC. So it's the lemon problem in some way in information asymmetry. And how we can distinguish a good lemon from a bad lemon. Actually, this is something that is more on the regulator, and probably with a consultation with the industry, where they can find a solution that for sure is on this forward-looking statement to remodule this kind of approach, especially on the point that only good and qualified sponsor they can get a promising company on the market, because otherwise can be very risky. And we have already seen some of those results that were very negative. Not only, but a qualified sponsor, and there are already studies in economics, it is already shown that after the business combination, the value of the shares is going to increase. So the SPAC is creating value, but it's creating value as far as this sponsor is qualified, knows what he's doing. He has experience in private equity. He has experience in M&A deals, or maybe he's even a SPAC serial sponsor, they call it. So it's a person that has sponsored already in his past 3, 4, 5, 6, 7 SPACs. This can help for sure. But another point is to start to regulate from today the moment of the business combination and what kind of sources can be available. because if we start to base again everything on credit, of course, we have seen in the global financial crisis, the problem of debt is something that then is an amplifier. So if then these promising companies not making profit can generate a sort of, and there maybe with Catherine, the systemic risk, so can generate a sort of domino effect, so that people then at the end, they don't have the money to pay back the lender. And this is something that then can generate further problems. So in SPACs, we can say everything is a little bit on the business combination, also because it is a risk-free investment. So as even Professor Davis was saying before, there is a withdraw power of the shareholder to redeem the shares, and so to get back the money. If you are not happy with that investment, you can redeem when? Until the moment of the business combination. Because if the business combination then is approved and you approve the business combination, you cannot redeem anymore. You are stuck in the deal. That is the only big point or problem, that the risk is something that is free in SPAC, because actually are not companies at the start, but then becomes a normal operating company, because once there is a reverse merger and the private company becomes public, at that moment, all the same rules of a public company are going to be applied. Another point may be that we can make, because sometimes we are fast to say things, is also the fact that today in the US, there are, for example, even accountancy principles that must be respected for public companies, and the private company that is acquired by a SPAC will have to comply with those rules, for example, in accountancy, or has to comply with transparency rules as in any other public company. So there are a lot of disclosures. The real point is this private company ready to be public? And this is the tricky part, because not only the managers of the SPAC, they must be qualified, but also then especially the managers of the private company, they must be ready to be public. So sometimes I think that the conception, especially in newspapers, they draw all the attention on the SPAC, but basically all this attention is more on the private company, because it's the private company that in some way, like in the case of Trump, maybe possibly is making misstatements, or for example, is making this corporate valuation so high when actually there is not value there. And so that is a big misstatement for then investors. On the side of the sponsor, another reform, for example, could be, because Professor Davis was speaking about what we call it the promote. So the fact that this sponsor, they acquire at the nominal value, for example, $25,000 is the nominal value. They acquire founders' shares at the moment of the IPO, but then if they complete this business combination, they will have the equivalent of 20% of the new public company. This is the reason why Professor Davis was saying there is a big incentive to close the business combination, because of course you can become millionaire, multi-millionaire, if you close with 20% of that value. The only fact is that already we have seen, and it's written also in the book, that some very diligent sponsors, they actually started to modulate this kind of 20%. So some of them, they started to say that they will take only 10%, and then progressively they will take 5% each time if there is value created also for the public investors. And this is a good practice. So I mean, and this self-regulation, I mean, is coming from the same sponsor, the same market operator, without any, I mean, fulfillment of any specific rule. So this is another point of the book, that the industry is a market industry driven field for sure. On the other hand, we have to say also that, I mean, the sponsor must be very knowledgeable about the market that is going to acquire, but must be ready also to, for example, say at the moment of the business combination, I will not take 20. I would like to protect investors and to not dilute investors and take maybe 10%. If he knows, because that is the, as I said at the start, insiders, outsiders, only the insiders will know really for real if that business combination is going to make and to create value. So that insider should be diligent, should be also ready in some way if he knows that there are some problems in terms of value. He should be ready, I mean, even to withdraw a part of the promote, for example. And this is something that could be the solution, possibly. More than saying, because, for example, the Financial Conduct Authority was always on the side of disclosure. So, for example, today in London, you can list a SPAC. You have to have more than, or at least 100 million in proceeds raised by public investors only. If you have that, the suspension of trade doesn't apply to you, and that is good. But they want also, in addition, if you can possibly, to say how much promote at the end of the business combination you are going to, for example, take or to withdraw, for example. That is a very good point. That, for example, is something quite good. The problem is that how the sponsor can know. At the moment of the IPO cannot know, but probably maybe if this kind of disclosure can be made closer or before, for sure, the business combination, once maybe the negotiation starts and they are going to secure a deal, that is very good, because can also inform the investor on how much dilution is going to receive, and it's also showing maybe the diligence of the sponsor that knows that probably because the time has passed and he has to close the deal in any case, he can probably say that instead of 20%, is going to take 10% of promote. So the investor already knows that it's not a brilliant maybe business combination at the end of the day, but probably can even trust more the sponsor and not redeem the shares. So, I mean, everything is a little bit in the transactional side. This is why the book is highlighting this point a lot, more than the financial regulation that in some way is a little bit static. Well, SPACs are very dynamic, but not only SPACs, all the financial innovations of today, so even Bitcoin, cryptocurrencies, fintech, smart contracts, are all things that, I mean, the regulators is a big challenge for a regulator to keep the pace of those financial innovations. And another point, very big point that still today has never been solved, is the operational risk. So how we can stop people to think in a mad way. So there is no rule that could apply potentially to this. So this is also something that the book is showing, that this kind of challenge or fight for regulation is something that, I mean, will always be there, especially because we cannot prevent or we cannot regulate operational risk, and so we cannot enter in the minds of the insiders and maybe prevent them to be emotional. That is something that many times is also happening in financial markets. I hope that I answer a majority of points with some also new hints.
Thanks, Daniela. And Daniela, we do have some questions. So if I put two questions to you, first of all, first question is, can you name some banks in Italy and in the UK that specialize in SPACs? And the second question is that the London AQSE, a Craze Stock Exchange, has now renamed SPACs to Enterprise Company. And the question here is, what are your views on that?
Basically, the Aquis is not part of the London Stock Exchange. Aquis Market is always a stock exchange in London, but more for other types of companies that are small, medium size in some way. I actually work with them in this SPAC reform that I had in London. And it's true that they call now SPACs are a form of venture companies. And this is making my point. So basically we discussed, I was invited by them also because if everything is going well, I should sit in the board as an independent director of one SPAC that will be on that market. And this is already showing you one thing in London, that because the regulation on the London Stock Exchange is so strict, today we still have 0 listing of SPACs and we have only one potential that is coming on the London Stock Exchange. But many requests were from Akis market. Akis market is having a lot of requests because there is not this kind of limit of 100 million that you need to raise. And there is no suspension of trade of the shares at the moment of the business combination. So as I said also in the book, and this is confirming my point, self-regulation is key. So basically SPACs, they don't like regulation. As soon as there is more regulation, and this was shown also in the US, for example, in the blockchain companies, they started with Rule 419, a lot of regulation that disappeared from the market. And a little bit now also in London, they started with very heavy, too heavy maybe to start to welcome SPACs, and they disappeared. So basically they don't, but they always move to another side, that is unregulated market, that is this Akis. Akis actually then is not really unregulated because they have always market rules, but more flexible. That is the point. So Akis, yes, is mentioning them as venture companies. So they are focusing their attention on the transaction side, as I said before. So no more on the fact that the SPAC is an IPO, but the SPAC is a venture company. It's a company vessel that is going to acquire another business. And possibly even there, many things they should be implemented on the transactional side, especially in terms of debt, for example. This is something that we discussed a little bit with the board, but it's something that, of course, they prefer also the market to be free, also because it's true that a sponsor, can be free if wants to, I don't know, raise money through debt or equity or in other ways. So in reality, yes, they are quite permissive, let's say, in this market, and actually is what they like, also investors like there. In terms of banks specializing in SPACs, for sure we can say this for the US. In the US market, yes, JP Morgan, Goldman Sachs, there are many underwriters that today they specialize in SPACs in the US. They have really also departments of specialist analysts that they can raise funds only for SPACs. In Europe, in general, there is not still a great expertise on SPACs. It's all something that if you go even, for example, especially in Italy, they still see SPACs as a traditional IPO. So they tend even to have expensive fees, more than US. And this is something that can be challenging. Although I think little by little, the things are changing, and especially there are some countries that are more permissive than others, like, for example, even in Spain, and that in Spain is very new. It's a new reform because there is in Spain a big reform of the financial markets this year. And next month, new rules should be in place in Spain in order to supervise SPACs. And seems that even there is a trend on the transaction, for example. This is something that I'm organizing also a webinar with lawyers in Spain, and probably I will then share with everyone. But could be an interesting point. SPACs, as you can see, are evolving. So it's something that is in continuous evolution. If those points then in some way can be, can conform what the book is saying, for sure, can be even better. Thank you.
Thanks, Daniele. And we have a question in the chat here as well, just to clarify an understanding of SPAC. So the question is, does the newly merged company automatically become a public listed company?
So the new, sorry?
So does the newly merged company automatically become a public listed company?
Yes, I would say not automatically, in the sense that they must fulfill all the disclosures of a public company. So basically, yes, it's not something automatic. It's always under and subject to the Security and Exchange Commission in any case. So it's a process that, of course, is simpler because you're already on the market. So for sure, the forms of communications also that you have to make is not like a prospectus of a real traditional IPO. But there is what is called in the US a Super 8K. So basically, it's a form that you need to fill in with the SEC, and is quite long. I mean, it's describing all the new activities and the measures that you have put in place to assure protection also to investors, transparency of the decisions. So no, it's not automatic process. I mean, it's not, absolutely.
Thanks, Daniela. And Paul, did you want to come in here?
Yes, just to say, I agree with that. Certainly in the UK, the FCA talks about the merged company having to apply for listing, which implies that it doesn't automatically become listed. And that I think seems to me a logical consequence of the way the merger is supposed to go. So the assets of the SPAC are transferred to the operating company in exchange for the issuance of shares by the operating company to the shareholders of the SPAC. So that suggests that what you end up with is an operating company with a new set of shareholders, but this operating company, by definition, is not yet listed. So it has to get a listing approval from the FCA. Look, while we're chatting, I began to think that there might be another way of regulating SPACs in the interests of investor protection, which would have a lesser hit on the chances of the funding failing, though it's a proposal which has its own disadvantages as ever. Why doesn't one simply not regulate the SPAC at all? Say to retail investors, you should steer clear of these vehicles. In fact, you might even prohibit retail investors from investing in SPACs. And you might therefore confine the investors to institutional investors and sophisticated individuals who are probably well placed to choose and monitor the management of the SPAC to ensure that in most cases a decent merger is done at the end of the day. See, that would be an alternative way of proceeding, and you wouldn't have this problem then about vetoes of the merger or returns of the funds contributed at the point the merger is about to happen. You wouldn't have to bother about pipe investors, etc., etc. I think governments don't like this because this is, after all, a way of getting companies onto the public markets, and they think retail investors should have the opportunity to invest in these vehicles. But it's the system we essentially have with private equity, where it's very difficult for an individual to invest in a private equity limited partnership. You have to do it through an institution. Retail investors would still be able to participate in SPAC investments, but via intermediaries. They wouldn't be able to do it directly. And that, it seems to me, would solve quite a lot of problems unless you think, and I don't believe this is true, but I don't really know the answer, unless you think that the exclusion of retail investors would mean there wouldn't be sufficient funds available for investment in operating companies. I doubt that's the case, but I might be wrong about it.
No, absolutely. I think it's quite interesting, your point of view, in the sense that, I mean, if we are going, I mean, to prohibit retail investor, the only point I think is the thing that I was mentioning before in the US, especially, that they see this kind of SPACs are a sort of opportunity for investors, retail investors, to join, because there's a lot of things is on the idea of the SPAC, what the SPAC represent. That is the big point, because even, for example, I was reading a newspaper that was saying that the GameStop saga was like in the philosophy of a SPAC. for example, with this continuous raising of money and value. And so I think in America, there is a big philosophy of SPAC. So we still need to understand what is a SPAC in the first place. So what really represents. And then from there, we can say in some way, if one party can join and the other cannot join. I think that the philosophy of SPACs behind is that there is a big tolerance. So everyone is the same, everyone should join, everyone should be in some way on the balance, on the same level. So that is the idea, especially American idea. But for sure, I think that maybe, and this is true, what Professor Davis was saying, especially in Europe, is not like in the US. So especially in Europe, and this I can say from Italy and from other countries in Europe, I mean, are institutional investors that invest in SPACs. I mean, really, there is not this tradition of retail investors investing in SPACs. It's something very, very minimal and something that is quite in existence. But exists in the US. In the US is quite big phenomenon. And it became a big phenomenon because it became a mania. So basically, I think the mania side was there, I mean, in the market.
Katrina,
do you want to come in here?
Yeah. I would like to ask you, because there was an argument in one of part of your book when you make reference to how company law somehow informs the regulatory framework of SPACs, in particular in terms of shareholders' right to redemption, of course. And in that part, you argue that civil law countries may be less friendly with the idea of promoting SPACs as the way they approach this form of shareholders protection and how they exercise some of their rights. So that particularly interests me because in small countries that we have liquidity problems in capital markets, let's say liquidity restrictions in capital markets. Do you think that somehow the fact that we follow the civil law tradition makes even more difficult for us to consider SPACs as our market, SPACs as a way of promoting capital markets development? Or how do you see that, Daniel?
Yes, basically, I mean, I think as also when we spoke in Colombia, generally, I mean, there is a trend also in South America. So it's not only Colombia, but also Brazil and other countries. But Brazil, especially in this moment, I mean, we have many SPACs, or better, many sponsors that are Brazilians, and they go to list always in New York. And then they acquire a company that is in Colombia or in Brazil, or generally, I mean, that is from there. The liquidity of the capital markets counts. So in some way, it is true that it's something that, I mean, we cannot compare like the capital markets of Colombia with New York. So every sponsor at least would like to go in the most liquid capital market, that is New York in this moment, might be also Amsterdam, Euronext, London, in London Stock Exchange. Once you reach this liquidity, it's also true that if we think about, for example, South America, a lot of wealthiness is created by the private sector. So, for example, even now the trend is private equity firms, they go there and they invest. And in the same way, the SPAC is seen in this kind of ways. I mean, in South America, that I can venture, it's a venture company, basically. They try to conceive the SPAC in South America as a sort of venture company that is creating, I mean, a value for the society also. And in fact, for this reason, I said before, what is our idea, conception of SPAC? what is the SPAC in general, even from a philosophical point of view, because can be seen also as something that even normal private companies, that maybe a Colombian company that was not famous in the past, but tomorrow it is listed on the New York Stock Exchange. So it is a way to provide access to finance, it's a way to give democracy to financial markets, where basically even the IPO, in the end, at the end of the day, also I've been in tables as a lawyer with big bankers and underwriters. If you assist a company in a traditional IPO process, in the end, at the end of the day, you always find an underwriter that has a lot of power, because they have a lot of money and they have a lot of influence in the market. And this is something that is quite challenging. I mean, you need to be a very big company with a very good and sound balance sheet to win this competition and to have the possibility to be listed. The SPAC is giving this dream, substantially. It's giving this possibility to also people that they don't have this outlook. So they have an outlook that is more modest. And so probably JP Morgan will never admit them inside their building. And they have the SPAC. So the SPAC is the new JP Morgan that is giving them this possibility to go there on the market. So it's quite a philosophical point. It depends, it's a little bit also a new philosophical point in terms of company law, if we think, because the corporation as a sort of vehicle in some way is a legal tool that was created also to take risk and so to create progress in society. So the fact also that there is a limited liability on the side of managers and especially shareholders that are limited to the investment that they're going to make, this has created the possibility through the legal personality of the corporation to, develop commerce and everything. And this is a new financial innovation, the SPAC, little bit like a company, but this time it's a casual company, it's an investment vehicle, but an investment vehicle that is limiting liabilities also. And this is, I think, the thing that is fascinating in SPACs.
I guess that problem with liquidity might be partially solved in the upcoming years, because we are in the process of merging Colombian stock exchange, the one in Chile and in Peru and maybe Mexico is also being on that deal. That means a greater change from what we've seen in the process of trying to improve our liquidity levels. Otherwise, I don't think that the Colombian market would be prepared, ready, not only regulators, but those who participate in the market. Who is going to be the sponsor? We actually have enough confidence of those who might be the possible sponsors. That might be one of the key issues. I will explore more how our company law actually could be a tool for helping this SPAC movement here, because there's still a question that appeared in my mind when I was reading your argument, trying to compare common law trends in front of some civil law countries that you studied. But thank you very much, Daniel, for your question.
Thanks to you.
Daniela, can I just finish up then with one final question? So you did mention at the outset that the next 10 years could see a lot of change, for example. Clearly, this is a fast developing area, as illustrated by your point about Google 10 years ago showing 150 results. Now it's in the millions. So what next for Daniela? What are your plans with developing your research further or your practice further in the area of SPACs?
Thanks. Yes, as far as I can see, for sure the development will bring SPACs closer to private equity. So there will be probably this kind of a little bit similarity in the market. Then at the moment I'm working on an edited collection on SPACs, basically where there are different scholars around Europe, and we discuss European SPACs, more European SPACs. But I'm also working with a White & Case with a partner, Ferdinand Mason, and we are having, always an edited collection, but this time only focus on this SPAC, because if 2020, 2021 was the year of the SPAC, 2022, 2023, 24, that will be the year of this SPAC in some way. So from that year, especially I think this year and next year, by the end of next year, we will know how far the industry has gone, how much success was there, and we can evaluate some trends. For sure, I think, I see the SPAC as a part of a phenomenon in financial markets. So, it's like that my career started with SPAC, but it's difficult to end with SPAC, because basically I like in them this kind of democratization of financial markets. So to put all the participants on the level in some way. And this is something that is very similar. And in fact, also the Security and Exchange Commissioner in the past, I think in 2021, he was comparing SPACs and Bitcoin. So, and it's true, there is a lot of similarities there. So probably the line of researches, yes, will be a little bit on the side that is not always with the JP Morgan of the day, and so with the traditional knowledge and the common wisdom, and a little bit more on these other alternatives that sometimes are overlooked, like in the past, the SPAC, because really when I started, no one was really few people, and I think in economics, the majority were, because there was Professor Vulanovich, and but in law, yes, also of a PhD, and in fact also that at the start I spoke with different supervisors, only a supervisor at Borbet University that, as you know, they are a little bit alternative. They had this opening to SPAC basically, but otherwise, usually in very traditional schools, even of law, and this is the reason why in law we are a little bit slower in comparison to economics, arrives always later once something is established and is sure that that is there. And in fact, I receive it then very fast. Students that they want to do LLM dissertations in SPACs, a PhD in SPACs, now in law is developing something. So we are just at the start. And I think if I need to do a prediction, I don't know the future, but I think that this journey in SPACs for myself and for all the ones that are involved in SPACs started from passion, from desires, from dreams, from something that is a lot of satisfaction in the good and or in the bad, when something was not there and then is there. So this is, the main trigger that I think the investors in SPACs, the scholars, my students, they enjoy in this moment. Thank you very much.
Thanks, Daniele. So all that is left for me to do now is to thank our participants, thank our two commentators, Professor Paul Davies and Professor Catherine Arias Pereira, and finally to thank you, Daniele. So Dr. Daniele Dalvia, congratulations on your book, and thank you for launching your book here with us today.
Thanks to everyone. Thank you very much. Thank you.